Yo, what's good? I'm going to be talking about a system, a strategy that I'm looking at. I want to keep it as exact and concise as possible. So we're just going to dive in. Basically, it has to do with these very, very rare occurrences, which is a 5R or greater in the spreadsheet. Um, it happens very rarely. I can tell you right now, it happens 2.9% of the time in the past 29,000 trades since January of this year, trading NASDAQ 15-point increments. In reality, it should, because it pays out 31R, a 5R trend, and I'll get into how that is. It pays out 31R. So 1 divided by 32 would be 3.12%. So inherent odds should be about 3.12% when, and it's also, but experimentally it's 2.9%. Anyways, so let's look at what I'm talking about here. So what I'm talking about, first of all, I've got to turn off these dingers because you're going to hear a lot of dings. There you go. So first and foremost, I just want to show you what I'm talking about as a 4 or 5R. You can see that this red dot is when we enter, and any red dot is when we enter. It's a stop and reverse system. You can see it went up 1R, 2R, 3R, 4R, and then fell. So it actually went up 4R in one way. And this one goes down. It goes 1, 2, 3, 4, 5R, and then comes back up. You see that would be a 5R. That would be a 5. I'm only talking about 5s and up right now. 5s or greater. 5s or greater. The reason why it matters, number one, is because if it goes in one direction, you can trail your stop. If you know it's not coming back up, obviously we never know, but if that's our assumption that it will not come back up, there's no point in just not adding to the position, and because your stop loss wouldn't be far away. Your stop loss is going to be trailed to here. Your stop loss is going to be trailed to here now. Now your stop loss, you just keep on trailing at each R increment until it gets stopped out at boom. It gets stopped out there. So the idea is that we can add and compound our position in an exponential way. And that's how we win big. That's how we lose big. That's how we win big. So in this circumstance, we we enter our position right there at that dot. We get one contract or one risk package, which can be a multiple of contracts, but let's just say for simplicity, just one contract. It's short, and then it goes 1R increment. We add in 1. It goes 2. We add in 2. It goes 3R, we add in 4. Why 1, 2, 3? No, it's 1, 2, 4 because we double our position. And then it goes 4R, we add in 8. And now each time we trail our stop. So we got in 4R. We're controlling a huge position, about 16 contracts, and our stop loss would be at 3R. We're actually risking 1R if it comes back up at this point. Only 1R in total. So, but we're controlling 16, right? So that's a huge deal. So it does go down. Let's say that's 5R. Boom. What do you collect here? You collect, I'll do the math for us, 31R. You collect 31R. I kid you not. Is there edge to doing that? The answer is no. The answer is no. We've done 29,000 trades, automated. There is a 2.9% chance of a 5R or greater happening. Okay, so there is no edge to doing that because you need to do it above 3%, 3.12% probability of happening, and it's not that. It's 2.9. It's very close. I would call this break even. I call this break even easily, and it's like this for every freaking thing that I do. 5R, 2R, 3R, whatever. It doesn't matter. It's the same thing every time. It's break even, dude. There is no edge to doing it all the time. The edge lies in when we do it. When is it a good time to trend? When is it a good time to do the opposite and double down on losers instead of winners? There's different ways to do this where you're short, you're short more, it goes down short more. That's a trending. You want to trend that thing. There is an opportunity to do mean reversion as well, where you're buying, it goes down more. You're buying, it goes down more. You're buying more. And yeah, you lose 31R on that trade. It goes both ways. What's the best time to do which? That's what my point is. So now onto my system. I know that's a little bit complicated, but now it's just beginning what I'm talking about my system. As you can see, this is the string of events. Short, long 4, right? Boom, a long 5. Finally, we get a 5R. That means there were 35 trades before a 5R. Now let's wait until the next 5R or greater. Boom, this one happens to be a 6. A couple days later, there were 60 trades before it finally found a 6. Do you know what that means? It means if you were trending it, you would be losing because you finally win 31R on the last trade, but you had 59 trades that you lost. So 31 minus 59, you lose 20-something R, whatever. So that circumstance was too much flatness, too much mean reversion, where it didn't pay. This one keeps on going. Boom, we got 25 trades until a trend. This one only went 2 more trades until a trend. If it happens 3% of the time, it shouldn't continue blasting. Boom, boom, boom. There shouldn't be that many 5Rs. I can tell you right now because it happens 3% of the time. It's very rare. 3% of the time, 0.321, 0.03125, 1 divided by that, about 1 every 32 times, 1 every 32 trades, there should be a trend. And you can see that based on my research, I looked, so now going into phase 2, okay, I'm trying to make it as concise as I can without taking forever. I just looked at how long does it take for us to find a trend. There was 25 trades before a trend there. In here, there was only 2 trades between them. This one, let's see if it goes long. Yeah, it goes pretty far. 27 trades before finding the next trend. Now this one, let's see how far it goes. Oh my gosh. 80 trades. It goes 80 trades before finally finding a trend worth 31R. So you'd lose 50R in that sequence if we were trending it. If we're trending it when it's not trending. So anyways, I looked at all of these streaks, the time in between a trend to a trend, and I looked at the average. And it's funny because the average is 33. This should happen mathematically because it happens 3.12% of the time. Mathematically, that's how it pays out. The average happens to be 33 times. It should be once every 32 times. Once every 32 trades, there should be a trend, and there happens to be once, on average, once every 33. So it's very, 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 very no edge. Flat. By flat, there's just no edge. But it does make sense that that's the case. Anyways, so what I did for this system is now I took all those streaks between trends. So this one happens to be 2 trades between a trend. Okay, this one happens to be 27 trades between a trend. And I looked at them and I said, all right, I put them all here. And I said, all right, if it's yellow, so if it's between, if a trend happens once every 31 trades or under, let's say 2 or 8 trades before another trend happens, that means it's trending to me. That means the space in between trends is shorter than normal. So that would be trending. So I call that yellow. And whatever's greater than, 42, about half the standard deviation above the mean, becomes red, where 80 trades between a trend, it's supposed to do every 32. Every 32 trades, there should be a trend, yet it goes 80 without a single trend. That would be qualified as mean reversion time, so that I labeled red. So what I did was, when it's trending, we trend. When it's trending, we trend until, boom, okay, I tried on that red one. So let's say it went 25, so That's under 31. So let's start trending the next trade. Right after that trend happens, we trade and we get a 2. That was there. We make 29R doing that. We'll keep on trending it. We'll keep on trending it because the space in between the trends is small. And what I did was, all right, the next one went 27. So we only make 4R on that because we finally get our 31R at the end. There's a huge drawdown until we get our 31R. And then our 80 happens. So we don't hold on for the 80. We get out, we try 31 trades, and then if we don't get a trend in 31 trades, but clearly it's not trending, I'm out. I'm done. I'll take my loss of 31R. Okay? So then that's how it works. And I did that for all of the trades. And guess what I did? I brought it into a chart. And here's the chart of the rolling profit. Wherever it is. Wherever it is. I thought we had the chart. There it is. Okay? So you can see that there's not much edge here. There's back and forth, but there's some serious trends here. So what this means is the profit of doing that same system, not the profit of trending all the time. Okay, we're doing a derivative of that. I'm trying to keep it simple, but I'm just saying that the streaks in between the trend, if it's smaller, if we see this spreadsheet, we see that there's greens happening. This one, there's a long streak of nothingness. That's called mean reversion. We wait. Oh, those two happen pretty quickly, but not quick enough. That's 38. It's got to go under 31. This is too long of a mean reversion. Look at that, 76 trades without a trend. I'm not going to trend. I'm not going to trend. We wait. Boom, there's 31 trades. I'm still not going to trend. It's got to be quicker than that, bro. Boom, boom. Okay, we got 2 trends right away. That's 0. Yeah, I'm going to start trending it. Boom, we see trends. Boom, we see trends. All right, the length in between the trend is smaller and smaller and smaller, okay? So that's why I'm saying, okay, let's trend. Until we see something go, we're going to keep trending this. Until we see something go 31 times, which is this happens, bam, 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 boom. Okay, now it's no longer trending because it went that stretch without a single trend. It actually keeps on going. Wow, 84 times without a trend. But we stopped at 31, so that saves something. So that's what that is. That's what this graph is. Saying that if it's short in between the trends, the short amount of time in between the trends, we're gonna keep taking those trends, and we're gonna keep trading it until it mean reverts. Now, the interesting part. I have a spreadsheet of the volatility. This is basically the number of increments in the day. And you can see that April 7th was a wild day. Okay, April 7th of this year, if you look at the graph on the NASDAQ or ES or anything really, it was unbelievable. Okay, unbelievable. It's the biggest day by far out of the entire year this year. Unfreaking matched. Not even close to normal. It was outrageous. I can tell you right now that the graph during that volatile event, I want to show you when that was. Okay, so we're going to look at that. I'm going to show you. I already did it actually. 161. I repeat, 161. Oh, hold on. Yeah, 161. Where's my graph? There it is. 161 starts at, hold on. Oh, I guess 161. Yeah, I can just do that. Never mind. 161 starts at, hold on. Oh, man. My bad, bro. I'm just trying to get to that graph and show you when that was. 161. 161's right here. Boom. Okay. So 161's right there. I'm going to have to take a snippet because I need to draw on this. So 161 is right here. So basically the beginning of the volatile event is right here. And the end of the volatile event is 200 of that. So what's 161 plus 200? That's 361, which is right here. Okay, so you can see if you take the volatile event away, that's basically the up move. And this is a consistent downtrend. Basically, what I'm showing you is that this time, this picture is the volatile event. That's April 4th to April 11th. During that time, the market was absolutely absurd. April 4th is right here, all the way to April 11th. Oh, just reset. That's right. And you can see that it was just absurd. So when we see volatility just acting up really crazy like that, we can say that let's go freaking trend. I don't care, man. Just trend the market. Just add your winners, trail your stop, add your winners, and just do that. That's what you do because the market's crazy. And that's what pays off. And you can see that this up move, this huge, I mean, the amount of R you can capture is, look at it. I mean, this is negative 800 down here. It went from negative 800 R up to positive 200. That is 1,000 R in the span of, I mean, not very long. Really, not very long. But for this video, we can't bet that that's going to happen. We can only say that when the market's going crazy like that, that's what pays. However, what pays when the market's not crazy? All the other days. What pays is actually doing the opposite of actually mean reverting. If you connect, let's connect this time with this time. And you can see that it does not create higher highs. You know what I'm saying? Connect this. Put it right there where it ends. And you can see that this thing just continues south. It just continues south. So let's do that. I'll just connect 361, which is right here. This 361 with 161, you can see 161's right there. No, 161's right there. All right. Basically, it looks like this. You can't get it perfect, but that's basically what it looks like, and you can't even see it. Hold on. 161 is right there. Yep. Look at that chart, right? Omit this. Just go from here to there. It just goes down. Only and simply and strictly just goes down. And what is that? How are you getting derivative off of a derivative off a derivative, man? How can I trust that? My point is that all that I'm doing is omitting the crazy of the market of April 4th to April 11th. And you can have that known. You can see that the market was a 243. You don't see the rest of it. You can see a 243. You can see that these bars are climbing up. This is something that you can see in the past, that you can see at the close of April 11th, before April 5th. So you can say that, no, I'm not taking the trades until I see a day that's not freaking volatile like that. And you can see that it goes down and only gets more volatile. Boom, boom, boom. Let's see it's something under 100. Under 100. Boom, April 13th. Welcome back, they say. April 13th, welcome back to normalcy. Welcome back, because that was crazy. That's basically what we're saying. And that's basically what this chart does. That's actually what this chart does. So now what is the system that goes in down like this? Obviously, we don't want to lose money, so we do the opposite. And what that would mean is called mean reversion. We would risk 31R to make 1. That's what this trend down is. I'm not looking for, regardless of up or down, I don't care. I just want positive edge. I just want edge in one direction, something decisive. And what I can tell you is decisive is mean reverting after a big streak. So let's go to our original spreadsheet. You see that the market goes down 1, 2, 3, 4, 5R and then comes back, right? That is labeled 5R right here, short 5. Man, this thing is volatile right now. There's 2 5Rs right away right here. Boom, boom. So this is moving, right? There's only 1, 2, 3, 4 trades between each other. I can tell you right now, if it's not a volatile day, which is today, it's not. The increment count is not crazy. You'd know if it's crazy. Trust me, you would know if it's crazy, because this thing would be dinging every freaking second. Every 45 seconds probably. But this is taking 6 minutes before the next trade. So what this would mean is we'd start mean reverting right now. We'd risk 31R at the very moment. At this very moment, we'd risk 31R to mean revert, to go back and forth, and to say that, all right, you can trend upwards, but just don't trend more than 4. You can trend up 4 and then come back, which is what generally happens. We know we have a 97% chance of winning every single trade. Okay? Every single trade we take, it's a 97% chance, which is pretty nice. We do lose 31R when we lose. However, if you see the graph and you take the trades after it goes, after it streaks, the system is after it streaks small, you trend it. So you can see this one's big. I'm not mean reverting when it's mean reverting. I'm mean reverting after this. Boom, boom, boom. Right? It go 2 right there. I'm going to start mean reverting this. I'm going to mean revert every single one of these trades. And that's actually what's happening right now. That's actually what's going on right as we speak, where it goes 1, 2, 3, 4 trades without a 2 big ones. You can see these 2 big trades. Boom, boom. Huge, huge trends. Right now, we should go sideways. Okay? We're betting on sideways action for 31 times in a row. Or until there's a next trend, we're going to do it more. The next trend, all right, this one's 27. You can see that it went 27 trades of mean reversion before finding a trend. That's 31 minus 27. We make 4. We lose 4R. But guess what? We're going to go trend again. And you can see that lines up perfectly here. You make the 4R is made there. And the next sequence goes 80 trades without a trend. So we'd make our 31R there. We'd actually make, in that sequence, we'd lose 2R. But we make so much more if you continue on. So much more. Clearly down. I mean, if you take this sample all the way down till, let's say, April 4th, you see it's negative 800. You can't see that, but negative 800 right there, which is just crazy. That's a lot of our negative. So the best thing to do, in summary, is to mean revert, risking 31R, 31R for 1. I'm talking $900 for 60. I think I planned that out. Nope, that's a 15. Oh, I have to risk more than that. I have to go down to $40 times 31. Yep, there you go. I risked $1,240 to make $40. Telling you. That's what I'm saying. Do that. After it trends twice, after it trends quickly, you do that until it becomes a mean reversion. So you go from a trending environment to a mean reversion environment. That transformation makes money, mean reverting. That's all I'm saying. That's what the edge is. So if this is confusing, I'm just going to go over it one more time in 30 seconds. Basically, you see that this is what happens to the market. It goes up and goes down. If it goes in one direction big like this, a 5R, it pays 31 out, pays 31R. Or if you mean revert and do the opposite, you're risking 31. You lose 31R. But all the trades in between, you make 1R. Okay? So when these gaps between trends become big, we don't take any mean reversion. When it becomes small and tight and concise, boom, 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 where this one's 31, no, boom, boom, that one happened right away. These gaps are becoming smaller. You see that? Now we actually want to mean revert. Right now, we start mean reverting right now. Boom, we mean revert. You mean revert until you find a green, or 31. Boom, you find a green, you lose 4R, okay, because you do end up losing 31 at the end there. Fine, but this gap is still small. We're going to take it. Lose, okay, you lose some there, but you keep on going, mean revert until you find, obviously, there's strings of times where there is no trends for so long. And you make money doing that. You only make 31R doing that. Every time it goes streaks 31, you stop at 31 and you're done until the next trend. But this is 84 in between trends. That means you wouldn't do it because that's way past the normal. I'm expecting some trend. So wait for the trends to happen. Boom, boom. This happens in 8. Now we start mean reverting again. We mean revert until we get to 31. We mean revert until we get to 31. Oh, lose some there. Mean revert. But really, you don't lose that much because you're mean reverting. You're collecting 1R each one of these. And you're losing, 31 minus 22. 9R. So it's not that much. You lose 9R. Okay, fine. But you're going to make 31 at some point. Boom, you make 31 right there. Because there's a string without whatever. There's a string without trend. Now, if you do that, you make a shit ton of money. You do. That's what the odds are from January of this year. That's what the reality is. Not including commissions, yeah, but I mean, if each R is $40, you're not gonna pay more than $3 or $4 in commission. So it doesn't take that much. It doesn't take crazy amount, but it still definitely matters for sure. It'll take 20% off of your bottom line probably. But yeah, that's about it. I know that was long-winded. I try to keep it small, but it is a complex system, not gonna lie. So yeah. All right, mate. So mean revert. That's what I'm doing. I should do that right this second. I'm mean reverting. That's what I'm about to do. About to finna do that, man. I finna do that. Which means I'm adding 1 at 1, 2 at 2, 4 at 3, 8 at 4. And my stop loss is at 5R to lose it all. However, we don't think it's going to happen, but it can. I know it can. But over long haul, it's profitable to mean revert doing that. All right. Peace and harm. Peace and harm.